a lot of people over the last couple of weeks reporting the container ships coming from China at 40% capacity from where they were before.
And so now this is just the next evolution of that, which is you don't need the driver, you don't need the person necessarily. Self-driving with Tesla is proving to be pretty good, and it doesn't have some of the human deficiencies.
You go from 6.76 today down to the low fives or even 5 pretty quick. You don't need the Fed funds rate to come down a full percentage point to make something like that happen. Episode 40 of Market Moves with Mark and Jeff. Jeff, we recorded 2 weeks ago, took a rare week off, hectic schedules with business for both you and I. Really glad to be back, but I remember specifically when we got off the last episode, we sort of needed a downer or an upper, I guess. Maybe it's the right way to say it. Because we were negative on that episode, and darned if 24 hours after that recording, did I feel we weren't negative enough given what the world looks like.
Yeah, we initially got off recording saying, man, that was a little more negative than we anticipated. And that you're exactly right, Mark. The message you sent me the next day was, yeah, it turned out we weren't negative enough. It's like as if, things couldn't get any worse. They found a way to do it in spite of our efforts to try to call things the way we were seeing it 2 weeks ago.
Jeff, I joked to you in kind of our show notes text thread that instead of two uninteresting guys talking about interesting times, that it might be two uninteresting guys promoting fear porn. Maybe that is where we are here. You don't want to overreact to the negativity, and I certainly believe that a lot of the negativity today is temporary. I don't know where all this is going to land. I don't know when the negativity is going to stop, but I do think, the negative headlines are present. They're covering real happenings going on in the marketplace, but I do think that they are reactions of uncertainty. I sure hope, my expectation is that we will have more certainty in, certainly by the end of the year, but hopefully by the end of the summer and middle of summer.
Yeah, I think that's what the market is really craving, is some level of stability and certainty. And we just don't have that yet. I mean, every time you turn on the news or look at headlines, there's something about a tariff that's, just been imposed or been pulled back, or a negotiated deal or whatever. And I mean, some of the articles I've been watching are saying that, CEOs, companies are just begging for some level of understanding of what is the future even going to look like. In fact, there was it might have been United Airlines. There was an airline company that had basically put out two different guidance forecasts, saying, well, if the economy moves this direction, this is what we expect. And if it moves that direction, then this is kind of an alternative guidance, which was, just unusual for what you typically get on a, earnings guidance, from these big companies, but just indicative of how uncertain the environment is in the moment, and that many are craving, good news or bad news, just help us understand what the future is going to look like for us.
Jeff, in whether or not your business's supply chain is sort of long planned, or from time to purchase to time to arrival and use of those materials or whatever it is, or short term, depends how much you may be affected right now. We certainly see. You've got the United Airlines, really interesting way to view this, because it is the way I think you've got to view it right now. But, we see builders saying, yeah, not really seeing price increases yet. There's been a lot of quarterly calls from the country's largest builders that are saying that right now. I don't think any of them expect that there won't be an increase at some point, but they're not seeing it yet. We see a lot of people over the last couple of weeks reporting the container ships coming from China at 40% capacity from where they were before. You see stories of Chinese manufacturers canceling, the delivery of these things halfway down through the ocean trip to the U.S. You see a lot of those things going on. I coach my son's 9-year-old select baseball team, and we one of the kids' parents is an electrician, and I think this is really interesting how it affects mainstream America. But it is, he's saying, I used to give quotes that were good for 30 days, but with the price of copper and other metals and whatever else is out there, now first I see all those quotes that I have to jump back to. The prices have gone up a lot, and he now is quoting on a 15-day time frame. His quotes are good for 15 days because so much is changing.
Boy, that interesting and not surprising based on how quickly, those changes are. On that topic in particular, I just saw headlines this morning that U.S. has an agreement with Vladimir Zelensky on a minerals agreement, and I don't even have all the terms and stuff, but that's been kind of a point of contention. But there's a desire to try to shore up or stabilize some of these raw material inputs that are just needed, copper and stuff on the electrical side, but all of the rare earths that are necessary for building batteries and all of the infrastructure that is just critical to have. And with us feuding with China in the moment and them controlling so much of that, it's I can see why we're looking for alternative sources. And so who knows how that all factors into this massive market equation that we're endeavoring to understand. But but just kind of reiterates the point that, man, the headlines do evolve every day, and it potentially can change your outlook on, good, bad, or any different for what tomorrow holds.
I really empathize with the business leaders that are dealing with what these tariff uncertainties are bringing to the table. And a little bit of it, Jeff, is, welcome to the world we've been living in for 2 freaking years. It's been this, and it is more of the same of that for us. But, when you're used to living in ice, another few months of ice is not the end of the world like it was when we first started experiencing this. But others, I think, are having to contend with the negativity here for the first time in a while.
Well, I think that's a good point, Mark. And I think indicative of the relatively strong economy that we've been experiencing on an aggregate level. When you look at GDP growth over the last few years, there have been segments that have been impacted. And real estate, whether appraisal or sales or mortgage origination, everything has really been impacted by interest rates, getting significantly worse a couple of years ago. So we've been living that, but others that that are producing durable goods or other things in the economy, the aggregate measures haven't said that there's been a lot of pain. Overall, it's just been targeted to us, whatever we've done wrong to anger the economic gods out there. But you're right, we've been living this for a couple of years, and does that have a material impact on rates and give us some relief as others, start to feel some of the pain? Too soon to tell yet. Rates haven't, materially improved yet to this point, but maybe that could be a silver lining for those of us in the real estate space.
The biggest uncertainty, I think, is those that have built their business on manufacturing products in China to sell here. Clearly, there's Cuts Clothing. In fact, I think the shirt I'm wearing might be from that group. But the owner of that company had posted, I've never seen his personality anywhere before, but was pleading with Trump, saying, "Look, I voted for you twice, and I support generally these things, but this is DOA for a good American upstart story here." And so you certainly feel a lot of that pain for folks that are centered around that stuff. I've seen other stories where folks are like, "Hey, I've been spending the last 8 weeks trying to figure out how to move my manufacturing from China to some other place. Help. I'm no further than where I was when I started 8 weeks ago. I've tried to consider returning it to the US, and it is equivalent to a 215% China tariff. So I'm better off just leaving it in China." But it was like I was offering money to someone that came up with a solution that they could use, and it's looking at Vietnam and wherever else. But these are not overnight solutions. So I wonder where we'll go, and it leaves a lot of uncertainty in the short term macro, which can have devastating impacts. Most businesses rely, kind of live paycheck to paycheck on a number of fronts, and so when you have 1 month of negativity, there's no way to absorb that really well, especially small business. So I wish a lot of those folks luck, and hopefully we get some certainty here around where this is going. For whatever it's worth, Jeff, I tend to find logic in the macro strategy certainly risky, certainly bold, very easy to attack right now in this moment. Major change like this is so primed for attack and sort of pointing out the negativity and the risks associated, and they're all there because they're legitimate critiques. And I watch business leaders watching these strategies, some pro this, some very, very against what's happening. And, I generally find logic in disrupting the world order as it's existed, economic world order as it's existed, in kind of rooting on the gumption to be able to try it. I don't know if it'll be right or not. It's way beyond my understanding, but I do find some hope, at least, that wherever we land, we are going to have an improved economic landscape.
Well, the proof will ultimately be in the pudding, as far as how it shapes out. There is the short-term pain. And we've commented multiple times that those in the administration have just said, dead face, into the camera when asked, yeah, this is going to cause some pain. And now we're seeing, those effects. And, it was certainly part of the calculation. I hope, for everybody's interest, that it plays out well and lands, as you're describing, Mark, in a good place in the long run, even though the short-term pain is real and unavoidable. I hope it doesn't cause short-term pain and not have us land in a better place in the long run. As they articulate the vision, I see it could play out and make sense. I hope that it does, but it's going to have to run its course one way or the other, and we hope to not be a lot worse off for it.
Yeah, I hate that other people are going through the sort of thing that we are. This pain that a segment of the population has to endure while we do something, but damn it, this is the story that the meal we have been served by the country, those of us professionals in real estate, for 2 years. Yeah, sorry, we had to do this to save the economy because of pandemic, and you just got to kind of deal with what's out there. And sorry, hopefully it won't last too long, but you just may need to take it for a long time. And that message has now been expanded to a larger population base within the country and the world to some degree. But all of this is a result of economic stimulus and quantitative easing for 2.5 freaking decades. We've got to do this to get out of the great financial crisis, too big to fail, and on and on. And, I remember my dad sort of switching political affiliations during all of that, just furious that in early 2000s, he's kind of the Bernie Sanders group that was, ultimately where he landed was kind of the Bernie Sanders group. It's like, man, no one is paying for all of this risk that people forced on the American public. And so chickens are coming home to roost. So we got to fix it at some point. We got to stop that at some point. And I do feel like a lot of the critique right now of attempts to fix are saying we had the best economy and the lowest unemployment rates that the country has seen in decades, and we're just throwing that all up. Well, a lot of that I think was propped up, Jeff. So, I don't like the propped up because that runs out at some point, and we've got to have true growth, true healthy economy here, and I hope that we're getting towards that.
Yeah, absolutely, absolutely, and it's just I think you make a good point. And the analogy makes sense. What we felt in the last couple of years is this correcting of, kind of zero interest rate policy from the Fed. And it's like, well, long term, there's got to be some interest built into lending money. And so, rates, the mortgage rates going from 2 to 3% up to 6 to 7 to 8% has a very intense short-term pain for anybody in real estate. And it, in other aspects, impacted by that as well. But long term, you've got to be at a sustainable level, and we weren't. And so, as painful as the last few years have been for most in real estate, you can kind of look at that and say, well, it sucked, and it's not, we're not out of the woods yet. but it sure logically makes sense that we've got to land at a place that works long term on the interest rate front. And so, just all of those things, how much it has really been propped up by government spending. We've been spending as though we're still in a pandemic when we're not, and I think that pain's going to continue. I hope it, runs its course, kind of like getting the virus. You go into the doctor and they tell you, yeah, you got a virus. There's nothing we can do for you. You just have to let it run its course, whatever the symptoms are. It's like, well, that sucks. But, hopefully this will, run its course and we'll be out of the woods.
Jeff, so this I kind of couch and we'll go deeper into this with some charts and some things to discuss in the pod. But this is present day economic troubles, one way or another. Part of these troubles, I think, are a topic that is sort of a personal interest to me, which is, where in the heck are we going with AI, AGI, artificial general intelligence, and all of this automation? And I think that the tariff hysteria is sort of taking eyes off the ball of the real thing that is out there, promising to make long-lasting, drastic change economically, and even how we live our daily lives. And so we've talked a little bit about this with Jim and several others. Just kind of covering headlines, and I'm fascinated from a lot of different angles. One of which, both you and I have kids that are looking, either preparing themselves one day to be out in whatever that new world is going to be, that includes artificial intelligence and all of the different agents and whatever realities are out there for that. But we've got some that are like having to make decisions now as to what they do with their lives or how they prepare themselves. And I'm continually interested in it. I think it really applies to the real estate professionals, because wherever that landing spot is, where this stuff lands, is going to dictate, what those in the middle of their career or beginning of their career end up having to kind of adjust to or become. So I think it all sort of dovetails into the theme of the podcast and where we go. But there was a headline. I think it was not a headline, but it was a tweet from Michael Simonson from Atlas, just someone that I follow. I don't know, but someone that I follow along with Twitter, and it just said that he's got a billionaire type tech friend that is a PhD, involved in artificial intelligence, and his advice to Mike's daughter was, man, you're about to graduate college, go travel for a year. And it kind of doesn't matter much because there's really not going to be a lot to do in 5 years. And, that is an extreme, but I talked to another real estate tech entrepreneur who's done really well and is kind of starting up again. And has got kids my age, my younger kids' age, and saying, yeah, I've got them in Udemy, which is sort of a learning platform, learning basic level coding, and but only basic level within the foundation of artificial intelligence. So kind of preparing them for all that sort of stuff. There's these no code options that are now out there that just don't require much coding. And I don't know. It's just, boy, I hope we can do at least an episode on this, talking to different folks and their perspectives on what the world looks like for our kids. Maybe is the reason we jump into it, but I think it has all sorts of consequences or impacts on those listening to the show.
Yeah, you're definitely right. And we've talked a little bit, online and offline about, this topic, like generally for, how would you coach or what do you tell your kids to do to prepare for the future? But it's a really good point that you make, that as the future and just the rate of change continues to evolve as quickly as it is, it's going to impact all of us, whether you're at the beginning or middle or tail end of a career. And there's change in the appraisal space with the way that we're going to be writing appraisal reports that go to to lenders and that sort of a thing. I mean, there's some of that natural change that evolves, but as we've explored or just thought through, like what does the future of analyzing real estate, valuing real estate, communicating that look like in an artificial intelligence world? How's it done responsibly in ways that, there aren't mistakes made that you don't even realize because of, utilizing, AI. It's just, there's a lot of really interesting aspects to how, this little niche that we're in, evolves, but it's going to impact everybody. The rate of change is increasingly, speeding up. It feels, and I don't see that changing anytime soon. I don't. I'm always impressed with the technologist's ability to project, the world being turned on its head in 5 years, and then you look up and it's certainly evolved, but it's not the Jetson future that that they were predicting 5 years ago necessarily. But the change is coming. The AI, it's really interesting to think about when ChatGPT first kind of took the world by storm. If I remember right, it was fall of 2022, and here we are 3 years later, and it just massive evolutions, and yet it's not doing everything for everyone in the moment. That day may be coming, but how we project technology in the future to look doesn't always play out, in practice the way that you expect. But it does, over the long term, seem to make a bigger impact in some ways than what people, anticipated as well.
Yeah, even the Jetsons, space rockets was manufacturing goods. There was still a need out there for sure, Jeff.
That's right.
And I follow Tesla really closely. I've been an investor for a really long time, as you all know, and so I'm following this robotaxi thing really closely. Yeah. And Waymo is out there delivering 250,000 rides a month right now in the 3 or 4 cities that they're in, and that is a fully autonomous car that is has nobody in the driver's seat, in the level of comfort that people describe when they get in and out of those things. They work really well, and it's amazing how quickly humans move from untrusting to trusting, once they get a little bit of proof. And now Tesla is here with a product and attacking that same market in a way that scales tremendously in a much faster way, where Waymo is sort of easing in. Tesla can put 15,000 cars in a city in a month and they all drive around. And so then you start to think, it's just such a curious case, because, okay, a car can drive itself. What does that mean? Well, it's fascinating, the change in landscape, like literally the change in landscape, if this is successful at scale quickly, where a car's utility, people drive a car from their driveway to their work parking garage, and then it sits there for 8 hours, and then you get back in it and you drive it home. Well, in these situations, the car just doesn't ever need to stop, right? It drops you off. It goes to pick somebody up. Do you need to own a car if you're the average citizen in the U.S.? Now, do you need parking lots in the same way? You don't need as many cars, because the ones you do have can be a lot more better utilized. And it just has drastic, implications on the family budget, on what our house needs in terms of garage, what kind of parking needs are at commercial facilities, and all sorts of things, if it works. And I don't know, but the point is, Waymo's doing 250,000 a month. Tesla in June is launching in Austin, and they are bringing scale to what Waymo's been doing for several years now. It's upon us, and these are artificial intelligence solutions that just weren't possible before.
Yeah, it's so interesting. And the point that you make about how quickly we can go from skeptical and distrusting to trusting is really interesting. And there are lots of historical examples of that happening. Even just the ride sharing economy. I mean, it was, really bad advice to get into a stranger's car at one point, in not the very distant past. And then all of a sudden you were paying people to come and pick you up. And so now this is just the next evolution of that, which is, you don't need the driver, you don't need the person necessarily. And, the trust will have to be earned, but ultimately, the Waymo and self-driving with Tesla is proving to be pretty good, and it doesn't have some of the human deficiencies that we have of distracted driving and drowsy driving and driving under the influence and all of those sorts of things that people have just kind of accepted as an acceptable level of risk that's out there. Of, yeah, people aren't perfect and sometimes they do things they shouldn't. Well, if the technology works as built, and it seems to be so far, it's potentially a safer option in many ways. So yeah, it's fascinating to see how these things evolve, and whether it's transportation or real estate or anything else in between. The technology is going to increasingly touch, and it is billed as driving productivity, like the utilization of the car that you just spelled out, of sitting idle 95 or 8% of the time to being leveraged and utilized a much higher percentage of the time. The technology brings the promise, or at least the possibility, of higher productivity in hard assets like that, but also in human labor and capital with what we can get accomplished in an 8-hour period of time.
You bet. I mean, just today on to an appraisal inspection, I think I took the full self-driving kind of automated thing in my car for 45 miles without intervention, and at this point I am so comfortable with it. On every level, just because I've been using it a lot. I got experience with it. So firsthand experience. It's really cool. It's amazing what's coming, and how does that then, how do you extrapolate those things with other aspects of what we do? Not gonna replace appraisers, just as one example anytime soon. I mean, I don't think that's the goal of it. It is a tool for appraisers, and those that don't use the tool may find themselves in a difficult competitive position.
Yeah, absolutely. Yeah, absolutely. Well, the conversation's been a lot of fun, Mark. You teed me up about 5 minutes in to maybe share a slide around negative headlines, and I just blissfully ignored you, and we just kept talking about whatever was of interest in the moment. But if you're up for taking a look at a few of those, we've already talked around a lot of that stuff. But as we were prepping for this, there really is some interesting trends and just some data that's showing up that I think would be fun to talk through for a minute before we've completely invented the future that we're going to live in.
Yeah, you bet. You bet. Yeah, let's dive in a little more micro and a little more real estate specific for sure. These are just a few things that you and I grabbed this morning. Words like weak, pullback, drop, worst in, worst generally, but worst in 30 years, all of these things we're seeing, and, just a few headlines in different areas that we see here. We've got agents, it's seller expectations that are just too high, that are frustrating agents. Jeff, I think you had a story of a family member who is an agent that is saying, man, you can't list high and then go chase the market down. That ain't the way to play it. I mean, probably ever. I think that's not the way to play it. Yeah. I don't know if you want to share that story.
But especially in a competitive market like this, that's relatively quickly gone from a seller's market to a buyer's market. So yeah, my brother's a real estate agent and has been taking listings. In fact, needed some help on a listing, not trying to figure out where to price it. He had a good sense of that, but trying to help a seller kind of reset their expectations. And one of the interesting things he was saying is he looks closely at a typical list to sell price ratio, meaning how much does somebody ask for their home versus what does it end up selling for. The more you can narrow that gap by just pricing it correctly and competitively in the first place, you're much more likely to be able to sell it, for a higher price. As he had dug in and done some studies, what he's finding is sellers are actually netting a higher price by listing competitively, which may be lower than their initial expectation, than listing too high and exactly as you described it, then chasing the market down and having it sit out there for months at a time. I just saw an article, I think I might have shot it over to you yesterday or today, talking about a buyer in northern Utah area that had bought a home 3 or 4 years ago, was now listing it, and it was taking months to sell, which they just weren't prepared for. They were ready to buy something else. And, just an interesting anecdote around the changing dynamic, in which buyers and sellers are operating, with sellers having less leverage and buyers having more leverage in the moment. And a lot of these headlines that we're talking about are speaking to that. The one that stood out to me is that March home sales dropped to their lowest pace since 2009. I mean, that's smack in the middle of great, financial crisis territory, where the real estate market was as bad as you and I have ever experienced. And, I don't know if it's how long it stays there, but we're certainly living that in the moment.
Jeff, that the sub bullet there on that article is, I mean, I hate to even say it out loud, but that March existing home sales fell 6% from frickin' February, which is notably kind of frozen winter sort of time frame seasonally. And so, just nasty. You've got inventory rising as a result. Mortgage applications in April really, I think, felt the tariff turmoil that's out there, and here, Nick Gurley, I don't know how to say his last name, but I do follow his account, and he specializes in fear porn, I think. So a little bit of grain of salt, but this is just facts. That April mortgage applications were down 43% from 2019, 45% from 2021, and 35% from 2022. So, just not pretty. And you've got the builders out there. The last headline that we haven't discussed specifically on this slide here is just ramping up concessions in regional housing. Florida and Texas are the ones taking it on the chin the most, with just a lot of inventory out there. And so a difficult world.
Well, yeah, it really is. And I think as we can look forward a little bit in a couple of these slides that just speak more to that on, the inflation front, and a lot of in the real estate space, what's driven the pain. We've talked about this a little bit already, is just the interest rates that had, to be increased in order to fight and address inflation. And so everybody's keeping a close eye on inflation. What is inflation doing? And is there any room for interest rate relief or not? You'd shared a few of these, Mark. What were you seeing on some of these inflation readings?
Yeah, so I circled the bottom right for those not looking. I think the important point here, and this is reflecting March inflation. So we've got April that has come and gone since this. Hard for your content producers at Market Moves to stay fully up to date with these charts here, but and there's been a lot of change since there. But what you can notice in the three inflation charts that we have here is a notable tick down in 2025 in inflation, and I think that is generally holding true in April, although these charts don't reflect April. Inflation is on the way down as we speak today. There is a lot of expectation that the tariff impact has not landed yet, and that we should see, those inflation numbers, start to rise. But, even today, I see, headlines commenting on Bessent's, Treasury Secretary Bessent's commentary from this morning or yesterday, that's saying the bond market is suggesting that interest rates should be reduced. That and that would be, I would translate that, maybe a few degrees of separation there, but I would translate that to say the bond market does not expect overwhelming inflation to be kicking in. We've got GDP slowing for sure. We've been seeing a lot of that coming out this week, as expected, with 40% reduction or 60% reduction in, container ships coming over from China and all that sort of stuff. So, I think you've got the gas being taken out of the economy to some degree during this time. And I think these charts are showing that.
Yeah, definitely. On the topic of fear porn, this kind of just highlights what you had addressed just a minute ago as well with the mortgage applications. It was just an interesting point I wanted to make, that the conventional wisdom in real estate, especially in sales, has always been that, things get really slow through the holidays and the winter months, and then you move into a spring buying season, and we've seen, this spring buying season be anything but robust. This year, the chart that we have up here is highlighting that April of 2025 has been the second lowest sales volume in the same month over each of the last years since like 1995 or something. Now, April of last year was a little bit lower, but though aside from those two, every other month for the last 30 years had seen higher sales volume, and so, or I'm sorry, mortgage applications on the lending side. And so it's just not this coming out of the kind of the winter freeze that you traditionally and conventionally will see happen.
It does. I mean, as I sit here, it isn't good right now, for sure. I think everybody knows it's not good. I think I listened to like an 18-minute interview yesterday with Bill Pulte, the director of FHFA, has made a lot of splash moves coming into that position with Fannie and Freddie. You know, I think he said it 10 times in the 18-minute interview that the goal is to make housing more accessible by affordability. And so you see that is where their heads at. You see that Trump's largely the economic plan or strategy is to lower interest rates and make things a little more affordable and economy booming sort of thing. So I think that the mindset is in the right direction. We just got a long way to go to see that impact on the streets.
No doubt about it. No doubt about it. I mean, the stated goal is there, and we've got a couple other slides I think that kind of illustrate exactly what you're talking about. What the messaging from Bill Pulte of how do we address this biggest problem. Any thoughts you had on this this housing finance forecast for April?
Yeah, so this is the Fannie Mae mortgage origination forecast here in a graph, and I think the most important thing to note, you can see certainly that we are in a trough. Surprise, surprise, it will be better throughout the rest of this year and next year. But I think the most important thing to watch with these things is Fannie comes out with this once a month, and it's the rate of change or how they see what they saw last month. What are they now seeing? And so 2025 mortgage origination expectations have been lifted by about 1.1%. So I think that's important, but 2026 has been lifted by about 3%. So, a little more optimistic about mortgage application volume, and it's about how I feel. I mean, I think that generally reflects my optimism once we get through some negativity, because I think we will see certainty. And when does that certainty start to hit? I think in a perfect world, you might see a rate drop before the first tariff deals are announced, but we get trade deals from India and Vietnam and Europe or wherever. I think we start to get some positive reaction from the market, and we start seeing where we're going to land, which will be great.
Yeah, absolutely. That's what everybody's begging for, and what will really help. In fact, on that topic, I'm going to jump a couple of slides here. It's been interesting to see the historic spread. I mean, really, I think that the stability would help anyway, but even as things, land in the moment, the slide here is illustrating the historic spread between the 30-year fixed rate mortgage interest rate and the 10-year treasury yield interest rate. And right now, there's a pretty big spread between those two, pushing 2.5% in the moment, where historically it's been under 2%. And so, part of what one of the things you shared with me, I think, Mark, was just illustrating that even if nothing changed other than the spread between the mortgage rate and the 10-year treasury, if it went back to a closer historical average, we could see a meaningful improvement in the mortgage rate, which would drive mortgage applications and also make some improvement on just housing affordability, which are some slides we can go back to in a second, but are also what's really causing the freeze in the overall level of transaction volume.
What a lot of people will tell you is that this increase in spread, first, this is sort of a signal of expectation of profit, or difficulty in getting profit from making a loan. That spread between the 30 and 10-year. And so in a really efficient market, you don't need as big of a spread because you're confident you can make money. And so what a lot of folks are saying is that regulation increase is a real reason for the increase in the spread, that it just takes a lot to do loans these days. And you've seen a tremendous consolidation of who's doing home lending out there. It's really moved to the big guys in all of this. And I think a little bit of that is a result from the great financial crisis, Dodd-Frank and that sort of thing. But along the lines of DOGE and the FHFA and HUD have certainly picked up these sort of themes. It is removing regulation through in the 18-minute Bill Pulte interview that I listened to. That was like kind of the central theme, is like eliminating fraud and reducing regulation. Talking about like radon, a lot of environmental requirements in analyzing a property and getting a loan done, and on and on. But what you could very quickly see, I think tariff deals done, a tick down in Fed funds rate, and coupled with the some of these regulatory reductions kind of landing, you go from 6.76 today down to the low fives or even five pretty quick. You don't need the Fed funds rate to come down a full percentage point to make something like that happen. I'm not saying it's going to happen, but the conditions on the field are such that that is not an impossibility.
Boy, yeah, absolutely. And so there's a little bit of hope or reason for hope, at least in the short term, regardless of how other macro events play out. So what was interesting as you were kind of on this topic around, the interest rate and the impact that it's having, really insightful. There were a couple of slides that I wanted to go back to, if I can, that were just, also interesting, but talking, speaking to the sales volume in particular. This first one, is a survey from Fannie Mae, asking potential buyers in the market, is now a good time or a bad time to buy a home? And this particular graph starts in 2010 through the present time. And you can see, it's from 2010 up through just past the pandemic into about 2021. You had as many as 76% of people in 2012 saying that now was a good time to buy a home versus a bad time, and that changed very drastically in 2021 timeframe. And right now, it's almost as bad as it's been in terms of perspective of people saying now's a bad time to buy. In the last 12 months, 86 to 80 to 86% of people have said, yeah, now's not a good time to buy a home. The only ones doing it are those that don't have much of a choice, life circumstance changes or whatever. And so conversely, you've got 25% or less of people out there saying, yeah, now's a good time to go ahead and make that home purchase. Interesting to see how drastically and how quickly that sentiment's changed over the last 15 years.
Boy, and it certainly reflects what you feel. I'm not sure what this podcast does from 2010 to 2017, Jeff, when it's just everybody's pretty happy and optimistic. I don't know what we do. We may have to switch to nutrition advice or something.
Well, yeah, we'll figure out some of that nutrition advice and then we'll start giving it. But I'll tell you this though, Mark, I would welcome some boring topics if it meant that we were back to a little bit more steady, row to hoe as far as just the market and the circumstances that we're living, because these last few years have been kind of painful.
Yeah, Jeff, I know you're going to jump to this next one, and this really does speak to. It surprised me a bit. It surprised me that there's such a disparity towards home prices. So this is for those not watching. What's the number one thing stopping you from buying a house right now? 72% of people indicate home prices are too high. Maybe 10% are saying mortgage rates are too high. And then, there's like 20% of the remainder that fall into the categories of there's not enough inventory, economic environment uncertain, concerned about my job or income.
Yeah, great summary there, Mark. Same with me. It really surprised me on this survey of people. I would have expected that as many would say that mortgage rates are too high as home pricing is too high. But it's wildly skewed on the perspective or the perception that it's just the home pricing that is too high out there. You get some real relief in affordability if interest rates are lower, therefore payments are lower, but that's not really what a lot of these potential market participants are looking at or pointing to as the primary problem. And I don't know if we see a real significant reduction in home pricing, but with some of the uncertainty that's out there, and without interest rates giving anything, to help on the affordability side, unless incomes dramatically increase, home pricing is the only other, thing that can give to help with affordability if rates stay about the same and income levels stay about the same. And so I wouldn't be surprised if we did see some continued pullback in home pricing. Anecdotally, I've seen a few situations where a home is selling today for less than it did 2 or 3 years ago. It's not across the board and it's not like falling off of a cliff, but by any means. But as inventory levels build, I mean, it could be a recipe for, some correction in home pricing.
And I don't, I mean, I'm a real estate guy to some degree that these headlines sort of find me algorithmically, I think. I don't know how much of the buying public or home participation public would be hit with these sort of headlines, but home price is too high. I mean, at the end of the day, what are people concerned about? Like, how much does it cost me per month to get into these properties? And so home price and mortgage rate, same effect, whatever, both or one needs to lower. But I wonder, when it's skewed so heavily towards the home price, or the stories like Austin and Punta Gorda, Florida, and wherever else where folks got into properties a couple years ago, when the real estate, hey, no time, date the rate, just get into a property, might be seeing, and I don't think it's happening a ton, but when people are getting hit with home price depreciation, I wonder if that's scaring some people off.
Yeah, it's a really interesting point, Mark, and it very well may be. We're seeing those headlines, where the biggest levels of inventory buildup is in those markets, that you just highlighted, Texas and Florida markets. And when you suddenly go from a place of feeling like I can sell my house for about what I need to and get out of it pretty quickly, to I don't know if I can or not, or man, I start to be upside down. There's just a psychology change in the market that starts to take place, both from buyers and from sellers, that almost becomes a little bit self-fulfilling when it's all said and done. So I don't know if that's ultimately what ends up playing out here or not, but it wouldn't surprise me if it did when it's all said and done.
Yeah, fascinating to watch. Jeff, you could jump to the last slide here, which just sort of rounds out the builder difficulty. This is D.R. Horton, and specifically on the right-hand side of the screen, this is Q2 of 2018. Net new orders was like 15,800. Last year, Q2 was 26,500 of net new orders. This quarter, or this Q2 of 2025, is only 22,000. So certainly better than kind of this, what I think has led to limited housing supply, from the great financial crisis to COVID. Just not enough building going on. But we are definitely seeing a material slowing. It's been, I think we said 40% of sales have been new construction nationally, where historically that's like 14%. But if the builders are the ones slowing down and they're doing all the selling, that is impactful, and I think noteworthy here.
Yeah, you bet. Yeah, good point. And we talked earlier on about, historically low existing home sales, being very low. And if builders pull back, it makes me wonder if, on a longer term basis, if we don't set up for a shortage again in the future, even though right now, all the headlines are that inventories are piling up. And in the short term, I think that may be an issue. In the long term, and it's kind of like we talked about with the interest rates that have to make sense long term to be sustainable. Housing rates, new units coming online have to be sustainable relative to a population growth. And, anytime you get out of balance one way or the other there, things end up having to, sort themselves out. I mean, that's what markets do, but it just doesn't happen very quickly in the real estate space.
All right, great, Jeff. Well, one more topic that's on my mind that isn't economic related, one that's kind of important to me. You and I have talked off and on about it over the last week or two, and I'm hitting you with it a little bit. We hadn't planned on talking about it here, and maybe it's helpful for the few that made it to the end of this podcast, maybe not, but it's where appraisers work in how lenders want to work with appraisers. I have seen messages over the last, 12 months or whatever it is, where there's you and I work for a large appraisal firm. We're proud to do that. We're trying to bring a new level of service to the marketplace by providing a lot of corporate support to appraisers, and meet some really stringent demands from appraisal management companies or lenders directly. And I have seen notes from AMCs and lenders at times. I think they're sort of accidental maybe to get out, but hey, our policy is not to work with firms. I work for a firm, and I'm disappointed in that. And I don't really know where to go with it, but I just kind of wanted to loft it up for conversation here. When appraisal management companies started hiring staff appraisers, or at least I became aware of it. Maybe they didn't start. It was around Dodd-Frank and all of that. There was a lot of conversations about this firewall in between the order of the appraisal and that. And you saw a lot of appraisal management companies having enormous staffs doing this. In fact, my father used to write on Appraisal Scoop, an old blog for any of the old appraisers that might be seeing this. But I think Brian Davis was the owner and editor of it. But it was, I think he was calling it the dependent appraiser, right? It's the appraiser that's working for the person that is ordering the appraisal. And it's not the independent appraiser, right? And it was sort of back then, maybe in the face of the intention of Dodd-Frank, or the appraisal portions Dodd-Frank, and that. And so anyway, I all of these things just it's the topic of where the appraiser works and does that matter. What are your thoughts on this? Where do you come out?
Boy, interesting topic, Mark. And I probably have a million thoughts around like how this whole thing works. I mean, the way I think about it is, and sometimes I give appraisers a hard time, but there's a market for valuation services, right? For appraisals, and there's a market for real estate agents to help you find or sell your home. There's a market for people to help you, get into a mortgage. What I see is that there are different ways to serve in the market. A lot of appraisers and a lot of real estate agents, work either on their own or in a very small operation, which is fine. It's a different approach to, being in a larger team or whatever. There's been a trend for a long time with real estate teams that have kind of specialization within that team where that they make sure that documents are processed, correctly and on time, and they're not missing deadlines and disclosure dates and all of those sorts of things. It's not just the one agent doing all of those things. In fact, my brother that I referenced earlier, kind of learned the business working in a very high volume, high production, type of a team with a specific agent who had a whole bunch of people that worked with him. And that turned out to be a pretty efficient operation. He learned a lot of really good lessons in going through that process. And appraisers, can be in a very similar, situation and are in kind of a similar dichotomy where you've got a lot of appraisers that work and do their own thing. You've got a lot of appraisers that choose to work within a firm or a group or a team, setting. And, I think the example that you're referencing around, somebody, putting out a message out there of, I don't really want to work with a firm. Historically, I've seen, situations where others have had that sentiment as well, because there's been a loss of direct communication, with the appraiser, or there hasn't been the efficiencies that, that perhaps were promised or probably should have existed given, the way that a prior structure might have been created. It's challenging to serve well a client regardless of your structure. I think that if you're intentional about the way that you set up and operate, the way that you communicate, the way that you keep a client updated and perform and get things in on time or early, at the end of the day, you have to prove it out by execution, regardless of what your structure is. And I think that the professional model is really less of the one person doing everything end to end. It's kind of the efficient dentist model. It's kind of this high production, real estate team model. I think for appraisers, when done right, it can be the same thing where the appraiser specializes in the valuation aspect and isn't also trying to call and collect the dollars and necessarily calling to schedule an appointment or updating the client 5 or 10 times throughout the life cycle of, while that appraisal order is active. It doesn't have to be the appraiser doing those things, but it does have to be coordinated and managed and orchestrated well. When it is, it can sing and really be a wonderful arrangement. When it's not, it's like anybody else, falling down a little bit on a service level expectation. Yeah, we hadn't discussed that. I mean, those are just some thoughts off the top of my head, Mark, but definitely I see some parallels there.
Yeah, I think my self-analysis, like why does this hit me? It hits me, seeing these messages. I mean, they're not overly impactful to our business one way or another, but we have been run through the scrutiny gambit over the last couple of years with appraiser bias in our practice. appraisers generally go through an enormous amount of training in the beginning of their careers, teaching them to do their work without bias. And it feels discriminatory to apply an experience with a appraisal type of structure previously to that same structure without knowing that entity at all. It's like stereotypical analysis, and it's just frustrating, and it feels like I see this all over. Appraisers particularly are just we have a hard time defending ourselves in a lot of environments, and so we really, when somebody gets their teeth into us, there's not a lot we can do. And I don't know, it just rubs me a little bit that way. And there's been a lot of what I would call new money, venture capital, investment dollars into the appraisal space over the last 5 years, and a lot of it, I feel like, has retreat's not the right word, but I think probably viewed the opportunity to improve service in the space. It was an opportunity when they first got in, and now look at it, man, this industry doesn't really want anything different. It's not receptive to it, and this kind of mentality is a little bit of that, and maybe it's good that new money came in and is interested in what we're doing now. I don't know, but I do think it speaks meaningfully to the difficulty that it is to operate in this space. And at the end of the day, if convenience and access to loans and affordability and responsible lending quickly, if that's the ultimate end game for our industry, the industry's got to help us get there as appraiser. You got to help us get there, I think. So, soapbox maybe, Jeff, but certainly how I feel.
Yeah, no, it's definitely an interesting topic and scenario. I will say, Mark, I mean, for what it's worth, I've seen far more that rely on and use appraisal services see the potential benefit of working with a firm, versus an individual appraiser. Just as in terms of conversations I can think of having had with other users out there, I would weigh it as being skewed more towards more larger lenders like some of the conveniences, some of the benefits of working with a firm as opposed to managing a whole bunch of individual appraisers. I don't look at it and cast judgment saying one is right, one is wrong necessarily. And certainly we've got both types of players out there in the market. The instance of someone, saying not wanting to work with a firm simply based on past or prior experience, I mean, same here. It rubs me the wrong way. I mean, it's like, if you have a reason that somebody's fallen down on an actual service level, yeah, no problem. I mean, don't work with them, whether it's a firm or an individual or whatever. But to not to want to work with an appraiser simply because they might be affiliated with a firm and have provided good service, but you just are kind of skewed against them doesn't make a lot of sense. I mean, that's not a logical approach in my mind.
Yeah, very good. Well, thanks for indulging me. We are about 2 minutes or 1 minute short of an hour. So one of our longer recordings that's not guest involved. So really enjoyed episode 40 here, Jeff. Look forward to experiencing the turbulence in this market with you going forward.
As always, I'll bring the topic out of the blue next time maybe and hit you with it and see where the conversation goes. But until next time, we'll be back.
Take care.